Alright, really important question, this one. So, a good question. I know that auditors are required to assess risks of material misstatement by getting an understanding of the business risk. And that's exactly what you should do. You should try and understand business risk, and that will then help you understand the risk of material misstatement. That's how it works. That's why we do this business risk understanding. But I'm not clear on the relationship between business risk and risk of material misstatement. Can you explain the two types of risk and how identifying business risk relates to the risk of material misstatement? So first of all, we had to identify them. So give a definition. So business risk is the risk that events could prevent an entity from achieving or reaching its objectives. And those objectives are normally to maximise profits, aren't they? But that's pretty much it. The risk of material misstatement is the risk that the financial statements are materially misstated, really important, prior to the audit. Okay, so prior to the audit. So that means, as it's prior to the audit, risk of material misstatement isn't the same as audit risk. That's what you've got to get clear into your head. Audit risk is made up of inherent risk, control risk, and detection risk. Detection risk is what we do in the audit. So if this is prior to audit, the risk of material misstatement is actually the inherent risk and the control risk, because it's all what the risk is prior to misstatement. Whereas business risk could be the risk that it's operationally run incorrectly. It's the financial risk of having too much gearing. It's the compliance risk if you're in a heavy regulated industry, all that sort of thing. So they're the three things really that make up business risk. And the risk of material misstatement is inherent and control. So you talked about that. And it says, can you identify how business risk relates to material misstatement? So probably done by example. Here's one where it's business risk and inherent risk related. Remember, inherent risk is part of risk of material misstatement. So it could be that you've got high gearing, or a company has high gearing, and they have covenants. So they have things, all a covenant is the bank saying, look, you must stay below a certain amount of gearing, or you must do something, otherwise we'll ask for our money back immediately. So these covenants are a bit of a worry. So the business risk is that the covenants are broken. The covenants are breached, as we call it. And if the covenants are broken, therefore the debt will get recalled by the bank, and that's going to prevent us making our profits. So that's the business risk. The inherent risk of having high gearing and high covenants is that the accounts might be manipulated. So the manipulation of the financial statements to prevent the covenants being breached. Always make the accounts look good, okay? So if that's the inherent risk, and therefore the risk of material misstatement is higher because they could be manipulated. The high gearing is making it favourable for us to want to manipulate. Another example would be then business risk and control risk. Could be that we lose key accounting staff. Okay, and if we lose key accounting staff, then the business risk is that we won't be as good. We won't get as good deals or whatever it might be that they get paid for. So they won't perform as effectively. The business won't be as effective. And of course, there's a control risk. If we lose key accounting staff, then we've also got the risk of kind of non-compliance, I guess, with accounting standards or whatever, or non-compliance just with accounting controls and with accounting systems. So there would be a risk of material misstatement because we've lost our key accounting staff, and they're the ones who produce the accounts. Okay, so let's just recap all of that then. Business risk is the risk that we don't meet our objectives. The risk of material misstatement is the risk that the accounts are materially misstated prior to the audit. We need to understand the business risk in order, therefore, to see where the risk of material misstatements might come from. So they help us identify where these material misstatements might come from and therefore respond to them.